So if you are confused, you have paid attention. The one thing I like to point out, the folks at the Fed are no smarter than your listeners are. They are cooking with salt like everybody else. The difference is that they got the button, they got the bazooka. And that's where my criticism is, that the Fed doesn't know what it's doing. It doesn't have a strategic concept. And so they're winging it. And that's just not a very healthy environment. If they do that, they should at least say so. I said we may be in the late 90s. But there are people who are concerned about valuations. And where do you hide? Gold is one of the places. The speculators, those folks have been mostly absent. They've gone more of the meme stocks. But if we have a significant run up or run down in gold, I wouldn't be surprised if those speculators come back to amplify volatility.
Hello and welcome to Soar Financially, a channel where we discuss the macro to help us understand the micro. My name is Kai Hoffman, I'm the JR mining guy over on X, and of course your host of this channel, and I'm really looking forward to the upcoming conversation here today. It's with Axel Merk. He's the President and Chief Investment Officer over at Merk Investments, and for some reason this week, this is the second guest we haven't had on in like 11, 12 months, and I'm not sure even why, because I made a promise that I'd get him back on regularly to talk about Fed decisions and Fed movements, but we spoke early in 2024, and the Fed hasn't done anything really until like September 2024. So we'll have to take that into consideration and to catch up with him. Like what's the plan for the Fed in 2025? How reactionary are they going to be? How data dependent are they going to be? And I should have said that with air quotes here. How data dependent are they going to be? So we'll have to check in with Axel, and of course we're going to check in with him on gold and gold mining stocks. They run a gold fund, of course, so who better to ask about gold and gold mining? Is 2025 the year gold stocks finally take off and catch the interest of the generalist investors? We shall find out. Before I switch over to my guest, let's hit that like and subscribe button. It's a free way to support our channel, and we tremendously appreciate it. Thank you so much. Now, without much further ado, Axel, it is great to have you back on the program. Happy New Year.
Happy New Year. The Fed hasn't done anything. They've done a lot, but they haven't done anything strategic. I would allege the Fed doesn't know what it's doing. But anyways, please,
yeah, so
ahead.
We had to wait till September to get anything out of the Fed, really. So maybe we'll start there chronologically, start setting up the conversation a little bit. Since you're a Fed expert and you do a lot of interviews around the Fed meetings usually, and I know you live tweet about the Fed decision when you watch the press conference as well. But maybe to recap, was the Fed too late perhaps in cutting rates, or were they way too early? Should rates be higher still?
So let me take a few steps back here. First of all, the reason we care about the Fed, I think it's worth to point that out, and those who've listened to me before, maybe I do this too much, but they set what's referred to as the risk-free rate. All asset prices are priced around that. And so we may not like what the Fed is doing, but they have the bazooka, and we should pay attention to what they do. It's also relevant that Fed policy is efficient, because the more one knows what economists call the reaction function, the better the market can price in how assets should be priced relative to that risk. And so the strategy matters, and the strategy matters much more rather than where rates actually are. And that's where my criticism is, that the Fed doesn't know what it's doing. It doesn't have a strategic concept. The Fed still has this asinine, I think that's the technical term, backward-looking inflation average concept on its book, and then of course most people recall the recent meeting after the election, the economic projections that were at some point discarded being irrelevant, and they were relevant for Powell, and then they said, okay, we're going to be data dependent, and guess what? Everybody is projecting what they think Trump might be doing, and so they're all over the place, and so they're winging it, and that's just not a very healthy environment. If they do that, they should at least say so. Indeed, though, I would much prefer if they said much less, because you should only talk if you have something to say. And if they don't have something to say, I don't see any benefit. It confuses the market, it increases volatility in the market, and that ultimately translates to less economic growth. Of course, it affects financial assets as well. But what you see is what you get. You have a Fed that doesn't quite know what's going to happen, and welcome to the club. right? Nobody knows what's going to happen, and that's kind of the point of a Trump presidency. They want to keep everybody a little bit off keel, and that's why one of my investment advice for 2025 has been buy popcorn, sit back and enjoy the show.
That's probably really sound and sane advice. Are you more of a salty or sweet kind of guy for popcorn?
Well, actually, I haven't had too much of it. Just had a. You got to add iodine to your salt. That's the important portion.
Okay.
But take it. Do some risk management in it. I guess that's translated to the real markets. Obviously, to if you want to go into the projection I have for 25, I'll be glad to do that. But if you want to do more on the Fed, let me know.
Yeah, let's stay on the Fed just a little bit, because I was a bit in December when the Fed, we were actually taking into consideration what might happen in the future, and he was hinting at a potential Trump tariffs and other things like that could impact inflation. I was a bit surprised by that, because in the year prior, pretty much, they said, all data dependent. We're looking at inflation. We're looking at unemployment. The rest does not matter. Were you surprised by that statement? As it sort of fits in the no strategic concept kind of statement that you made. Is that sort of what you were thinking about?
Well, in his defense, he's in a tough spot, right? And they got themselves into this corner where they say, we're data dependent and this and that. And then there's change. Election is change, right? Significant change. He has these threats of tariffs, which presumably are negotiating tactic and whatnot. But what they had signaled until then is, let's see what's going to happen, and then we'll adjust. Except, of course, the folks on the FOMC, the Open Market Committee, they're human beings. They can't help it. They say, of course, well, if they're going to put in big tariffs, there's all kinds of stuff that's going to happen. And then the other context, I think, that we shouldn't forget, and I think we talked about that a year ago when we last talked, once you have high inflation, it does not come down linearly, which means, yes, inflation has been coming down, but it doesn't mean every data print will be low, which means it's going to be a bit all over the place. And what the Federal Reserve has been trying to do is they're trying to say, okay, we were late on inflation. They didn't quite address why, but then they were tough. But then I put that time slot in October of 2023. Powell gave a mission accomplished speech. Most people put it in December. I think he was pretty clear about it in October already. And then the next step was, okay, now we can lower rates. And of course, they went out with a 50 basis point rate cut in the summer. And then, surprise, surprise, inflation didn't come down quite as much. The economy was stronger. I was in the camp of a weaker economy. It's about risk management, what to do. And now you have these cross currents, slashing regulations. Okay, that means more growth potential. That means higher rates might be warranted, tariffs, right? And tax cuts maybe, and all kinds of hypotheticals. We might get the economy into overdrive, or are we going to have this recession? So if you are confused, you have paid attention. The one thing I like to point out, the folks at the Fed are no smarter than your listeners are. They are cooking with salt like everybody else. The difference is that they got the button, they got the bazooka, right? And say it matters what their musings are about. I call it a debating club. And I wouldn't be surprised if when all the dust settles, we have some sort of environment that resembles the late 90s a little bit, where rates are going to be a little bit higher. This all is, of course, absent of some shock where they'll take out the kind of the foaming right away and then lower rates again. The other thing, though, that's very different from the late 90s is that the fiscal situation is very different. The geopolitical picture is, of course, very different as well. But the one thing that the Federal Reserve, in the back of their mind at least, has, even if they're not going to say it publicly, is that in all the big campaign things that have been said on both sides, by the way, Democrats or Republicans, fiscal discipline wasn't part of that. There's government efficiency, sure. I mean, who doesn't like a big scandal about government waste? But that doesn't change the long-term trend that the deficit is unsustainable. And with the tight majority that the Republicans have, you've got to give a lot of promises to get things done. So I don't see fiscal discipline on the agenda. And all of that means that yes, deficits might well prevail. And that is the context in which the Federal Reserve has to operate, which means that I think the market is probably about right that they don't see too many rate cuts here.
You said like all the policies are there to confuse the market, and the question is now, looking at the market, we're over 6,000 in the S&P 500. Like, is the market confused? Like, where are we at in the market right now? It feels like, and that's my gut feeling, I don't really have any empiric data on that, is that the market is waiting for something to happen, and I'm guessing it's the inauguration on January 20th for a clear direction. It feels like we're going sideways until then. I'm curious what your thoughts are on that. Like, is the market confused right now?
Well, the market is trying to make sense of what we've got. It's not the policies that are confusing, it's the potential outcomes. Back when I was a college kid, that was in the 1980s, I was all into probability density functions, the likelihood of different outcomes, the probabilistic, the chances that something is going to happen. And we are trained to think about the median outcome, the average outcome, but on average, a clock is at 12 o'clock, but of course, it rarely ever is. And so the dispersion of outcomes, and apologies for being so technical, but the point I'm trying to make, there are numerous outcomes that are plausible. And of course, you or I might zoom in on a particular outcome. The one thing that's noteworthy about these outlooks for the next year is always that they tend to be always wrong because something else is going to happen. And I think the market is very much reflecting that. And part of the reason you have volatility in the market is because depending on just a different reading of a particular data point or news, a certain scenario becomes more likely. And so suddenly scenario A is more likely, and then scenario B is more likely, and they have profound impacts on asset prices. So the market is doing its job and trying to find its way. I think in that sort of environment, what's most important is that investors have a plan. It's always important, but because if you don't have a plan, you're going to be thrown between scenario A and B every other second. Now, that doesn't mean you should stick to the wrong interpretation if once you realize it's wrong, but you got to test your hypothesis. You got to or lower your bar rather than trying to fine tune everything that's going to happen. Now you say, okay, this is the bigger picture, and this is what I can do in my portfolio, and how I'm going to prepare for all this. And so the market is doing its job. I don't think the inauguration is going to be a catalyst. I mean, I'm not entirely joking when I say get out the popcorn, because we know from the first Trump administration, and even, I mean, you say inauguration. I mean, Trump has been running the show. He is the de facto president in the U.S. Indeed, as we're speaking, we have these horrible fires in Los Angeles, and President Biden was visiting there. He couldn't have any of his meetings, but he got stuck down there. And so in the meantime, we're talking about Trump and the policy. So for all practical purposes, he is in charge. He's been directing foreign policy. Everybody's talking about Greenland and whatnot, right? So I don't think there's going to be a huge change. We'll see some drama about confirmation and so forth. And of course, we'll see some executive orders. But we know the game plan. We know the kind of the bombastic language. The substance is going to be about what actual stuff will get done. And that's far more difficult. In practice, I like to remind people, in the 1980s, Ronald Reagan tried to do a major tax reform, and he got it done, but at the cost of ballooning deficits. And that wasn't the plan when they started, but folks in Congress, they're not loyal to Trump. They're loyal to the next election. They want to get reelected. And so we've already seen it with these little tempests there, that getting the speaker reconfirmed, that was somewhat easy. But Trump wanted certain things to keep the government open. Just because he's the president doesn't mean he's going to get stuff done right away. He's going to be a lame duck from day one. And people will sooner rather than later think about their own reelection. So it's going to be fascinating. And the market is trying to make sense of it. My own take is that when we have a change in government, we always think it is amazingly important. And yes, they do change the trend. And I do think it is very important that the regulatory environment is going to ease. But don't kid yourself. We're not going to get rid of the regulations left and right. We're going to reduce the rate of progress in regulation, and sure, maybe reduce one or the other. I'm working in one of the most heavily regulated industries. I don't see. I see that it's going to be easier to get certain things done, but I don't kid myself. I mean, the cost we spend on compliance is just dramatic and has gone up substantially over the years. I don't think that's going to change.
Yeah, deregulation is a big topic that I've heard about from other commentators in the space as well. As like could be a big game changer, especially for the smaller cap companies. I'm sure what it is for the finance industry.
And it matters.
Axel, but
I mean, you're in Europe, right? And in Europe, you can't get anything done. I mean, the reason, part of the reason the populists are rising is people are frustrated because the quote unquote establishment doesn't change anything. They of course come with some sometimes ideas that are a little bit out on left or right field. But in the US, you have a much more dynamic economy, and you actually get things done. We complain about the regulatory environment, but the economy is large enough so you can actually outsource that. And so we have 50 states in the US, which means we have actually 50 regulatory environments. So people tend to not know that when they listen from Europe. But you just look at the 10-year yield in Europe and the malaise we have. I mean, it's very scary how Europe doesn't get anything done, and we may not like the way that Trump does certain things, but change is going to happen, and it's going to. And this enthusiasm. If you look at the consumer sentiment numbers, when a Democrat is in power, they are very depressed. It's because Republicans think that the end of the world is coming. And when a Republican comes into office, all the problems in the world are solved, and suddenly everything is great again, even though nothing has really changed. But it matters. Consumer sentiment matters. It matters that people are willing to invest and engage. And so all this talk about government efficiency, even if at the end of the day, they're going to achieve much less than the hype. If it does get people to make investments and engage in business, it makes a difference. And Europe misses a lot of that when they just look at all the bombastic talk.
yeah, no, we're way behind on so many things. Energy policy is one. AI development, we're way behind the 8 ball. Although we get government regulatory bodies set up, despite having no AI infrastructure or technology developed at all. But I'm looking for direction from the markets, and one place I try to get some direction from is the bond market. And the Fed has cut rates by about 100 basis points. The 10-year yield is up by over 100 basis points. I'm trying to make sense of that. Like, what is that trying to tell us? What is the bond market forecasting here, especially looking at 2025, where we have to refinance $3 trillion of bonds and bills in the U.S. and issue more just to finance the deficit in particular? Like, what are your thoughts on that topic and that widening gap here?
Well, I mean, there's a higher growth potential or higher inflation, and it's probably a little bit of both. As I look here on my screen, the 10-year real yield is at 2.27%. 5-year inflation expectations are 2.52. Now, a lot of people, before I go too much again into numbers, say, who on earth knows what inflation will be in 5 years? Who on earth knows what growth will be in 10 years? The point is that these are metrics that are relevant for the market, and changes in these metrics are very relevant. These longer term numbers are really confidence measures in Fed policy, in fiscal policy, more than anything else. Of course, nobody has an idea of what inflation will be over 10 years, but relative changes in these things matter for asset prices. And so a cut in regulation means higher growth potential. A lack of fiscal discipline means potentially higher inflation. And so we see a combination of that unfold in the markets. Also, the fact that, I mean, one way to think that the 10-year is kind of how rates will be over time is that we're not going to go back to the 0% interest rate environment. And so in some ways, it does look like we've broken out of the malaise over this decade of zero interest rates, and it's somewhat more normal. By the way, the folks that have a big problem is China. We haven't talked about that, right? In China, a few days ago, the Chinese government announced that you're going to get 15% discount on your mobile phone and whatnot as consumer stimulus. That is not the right medicine when you're faced with a housing bust. And so they're going to struggle for an extended period, but they're going to throw big money at the economy, which of course spills over to global markets. Sometimes we think that the policy is only domestic. Like talking about the Fed again, the Federal Reserve said, hey, everybody else in the world had inflation too. It's not our fault. And Lagarde said the same thing. Well, the stimulus we had in the US, the infrastructure stimulus, wasn't just large on the US scale. It was large on a global scale. And so part of the reason why we had global inflation was because of the US stimulus. And conversely, when China does something big, it does impact markets as well in the rest of the world. So we shouldn't forget that.
You brought up inflation. It's a topic I want to tackle with you as well, because it has been ticking up for the last 3 months. Are we at a point where we should be concerned about inflation? Is that just a normal course of action? Like you said, it doesn't come down in a straight line. Is that something you anticipated? We
should always be concerned about inflation. The Fed should always be concerned about inflation. We cannot take it for granted that inflation is low. And by the way, just saying that inflation is not linearly on the way down, the person who you wouldn't expect said this in his book is Ben Bernanke. He cautioned about it. He wrote a book in the pandemic, and then he added a chapter when inflation got up about kind of all the stuff that goes wrong when inflation goes higher. And it's one of the few places where I agree with him. The way you deal with inflation is with a good long-term policy. And that's a consistent theme I've been touting since the financial crisis of 2008, that the best short-term policy is a good long-term policy. And we don't have that. We don't have a long-term strategic plan for the Fed. We do have hawkish talk and whatnot, and the people think, all right, this debating club will somehow get it right, maybe, possibly, and if inflation goes higher, then they'll deal with it. But it's a very, very inefficient way of doing it. And we could get more growth and lower inflation if the Fed had its act together, or if they just kind of quit it altogether, if we replace that debating club with a rules-based Fed, where the market could have a much better idea of what future policy is going to be. But yes, inflation is always a concern. And the issue is, of course, ultimately the issue is that the interests of government that is overspending are not aligned with those of investors, right? You cannot have sound monetary policy when fiscal policy is unsustainable. You can do that for a little bit, but when we talk about independence of the Fed, and by the way, that's very important for monetary policy to be more efficient, because when you have interference from the government, when Trump says he's going to fire people, if that were credible, then it is more expensive for the Fed to conduct policy, rather than saying a few words, they might have to cut rates or intervene in the markets. And so it's important to have that independence, but monetary policy cannot do its job properly when fiscal policy is bad. Just like you can't have a gold standard if you don't have sustainable finances.
Yeah, no, absolutely. You brought up monetary and fiscal policies here. Does Jerome Powell get a valid or a decent counterpart? Come the end of January with Scott Bessent as a new U.S. Treasury Secretary here. What do you make of that appointment? And I mentioned it in a previous interview. I've listened to a couple podcasts and interviews of him, and I'm starting to fanboy a little bit, and I'm curious to see what he's doing or what he will be doing on terms of the fiscal policy here from the U.S. government side. What are your thoughts on that nomination, and are you looking forward to seeing more from him?
Well, I don't know whether I get my money's worth for the popcorn I'm buying. So that's really the. Let me talk about the positive first. He understands global dynamics better than many others do. He was a hedge fund manager. He was involved in currencies. So he probably understands those dynamics. On the downside, he's a small business guy. He's like you or me. We manage 1.6 billion, but I still consider myself a small business guy. I haven't managed a huge organization. Treasury Secretary is a huge, huge thing. Now, it's of course not the first government official that's been put in place, and the Trump administration has nominated several that doesn't have a deep, large business. And former Treasury Secretaries, when they've run Goldman Sachs and the like, that was unpopular for a while, but that means you know how to manage these big organizations, sometimes political ones. Now, you can address that by having a team that can help you out. And so that's the sort of thing I'm looking for. Will he surround himself with people that can take care of the politics of that job? Because it's one thing to say a few words, and I are good at that, right? We can talk, but doing things like running a big organization takes something different. Now, obviously, running my small organization, I think I have all kinds of skills, but it is still very, very different to run a very large organization. Now, of course, Janet Yellen didn't have that either. I don't think it was terribly effective, but of course, some of it is personality as well. But it all shows us these are just human beings like you and me. He has positioned himself to get this job. He seems to understand markets. That's all good. How effective he is, I have no idea at this stage, and I think the jury is out of that.
No, it's not an easy task. I think I also feel bad for the new president-elect a little bit because he's been handed a difficult hand dealing with the deficits, the U.S. debt. It's not an easy job, and it's an unthankful one that might the next president in 4 years might reap the benefits of.
Do you want to have a GoFundMe page for him, or? I mean,
I'm not going to shed any tears. Don't get me wrong.
Why would anybody want to be a politician, right? It's not a thankful job. And of course, there's only so much you can do. In order to get elected, you usually need to make promises that you can't keep. Now, Trump in his first administration actually followed through on many of the things he has done. He gave many, many more promises this time around. It's going to be very, very difficult to do this. The one thing that Trump did, and again, since I think you have partially a European audience as well, I think it's worth mentioning, he broadened the Republican tent, right? You may or may not like him, but he became more moderate on social issues. He on various issues, or this Robert Kennedy, for example, on the health side of things. He pulled those voters into his camp, and so he is a savvier politician than many politicians are that have been around the block for many, many years. At the other end of the spectrum is that the Democrats were just completely zooming in on their base, and so how to translate that into effective governing is, of course, a completely different question. But we'll see. He does seem to get certain things done. You just saw the announcement by Facebook to get rid of their censors and replace them with community notes. So the bully pulpit is effective. Change is happening with a change in government, and of course, in 4 years we'll have another election, right? And so the leadership matters. Leadership matters. And it's going to be interesting. And again, right, whether the Treasury Secretary is going to be terribly effective, I don't know. By the way, the Fed chair position is up for grab in the spring of 2026. The vice chair of regulation at the Federal Reserve indicated recently that he's stepping down in February or earlier. Trump already has somebody else before that. That is opposed, by the way, that Dodd-Frank regulation put in place. Maybe that place is going to be vacant. I wouldn't be surprised. I mean, that's interesting. It's going to be interesting.
Yeah, it's curious, and it's like if Trump will have any impact on the Fed at all. Like Elon Musk wants to regulate the Fed or get rid of the Fed to a degree. Although it's like I'm always curious, like if we were to do that, what would the world look like, or what would the U.S. monetary system look like without a Fed? Right? Well, I don't think anybody has a real answer for that.
The challenge is that a lot of folks in Congress, politicians, think that they can use the Federal Reserve to finance the projects that they have. That's not an abstract concept. And part of the reason why the Fed always talks cryptically is because they don't really want the world to understand that they literally create money with the stroke of a keyboard. And so they don't want Congress to get their hands on that too much. The one huge criticism of the Fed is the Fed has screwed up. and not for the first time. And it's just not acceptable. And they need to review what they do and fundamentally change the way they do business. And unfortunately, it takes disruptors. And what comes out is not always necessarily better. But if reform doesn't come from within, it comes from the outside. You see that in European politics, right? The populists are surging. It's because the established parties are just not taking the concerns of the public seriously. And if they did, one politician, if your audience is old enough, in the late 1980s, Franz Josef Strauss, the Bavarian politician, he said that we must never allow that there is a party that's going to rise to the right of the CSU, because if so, we are toast. He didn't use the word toast, but and that's exactly what happened over the last several decades. And that marginalizes the mainstream parties and allows the populist parties to rise, because the mainstream parties don't take those concerns seriously. And the same, of course, in the US, right? We have the rise of populism. Now, the US parties are kind of far more flexible in expanding their tent. And you need to be affiliated with the big national parties in order to have any chance of winning a national election. But it doesn't change the underlying sentiment that people are deeply upset with how things have gone, and they voted accordingly, right? And part of Trump is to disrupt. And so let's see what he destroys. And if he destroys things at the Fed, let's see what comes next. But institutionally, it's very, very difficult to destroy things at the Fed.
Axel, before we come to gold and the gold mining stocks, I think one last topic we need to tackle is the US dollar. And it has direct implications as a result of what we just discussed. We're looking at the DEUTSCHE of 109 right now. One could argue it's the cleanest shirt in the laundry, kind of, symbolism here. But what do you make of the US dollar? Is it just politics driven, meaning is just a powerful man in the White House or soon to be in the White House that's driving dollar higher? Like, what's driving dollar higher right now?
So, dollar 101, a few things. First of all, when inflation moves higher in a country, a currency often moves higher rather than lower, as you would think. And the reason is because the public thinks, or the market thinks, that the central bank will do the right thing and tighten monetary policy, therefore it gets stronger. It's then only down the road when the central bank doesn't do the right thing that the currency weakens. Second is tariffs matter. If impose tariffs, that's a dollar positive, and because it weakens some of these other countries. Ultimately, the dollar index, when you talk about it, it is overwhelmingly the euro. And so it is at least as much euro weakness as it is dollar strength. And Europe is just an utter mess. I'm just been talking with Bavaria. Germany has an election coming up in February, right? I just don't see how you can have a workable coalition based on the current polling results that's going to be an effective government. And so, by all means, the nuances are going to be different. You probably are going to have a right-leaning coalition if you can make a coalition rather than a left-leaning one, but they're not going to be able to conduct the sort of reforms that Germany urgently needs. France is just as much of a mess. Lagarde is conducting monetary policy as a politician, not as a. You should listen to her press conferences where she talks. One of the things she touts is Draghi wrote this reform to make the European Union competitive. It's one of the most misguided pieces that's ever been published. It is not about because Draghi used to talk about labor market reform to get the economy more flexible. Now, that report that Draghi published, and the media has mostly ignored the substance of it, it is about the EU spending 5% of EU, not the EU budget, but the EU GDP, on strategic investment. So an industrialist policy fostering climate technologies and other technologies, as if the government was able to best allocate resources, rather than easing regulations to allow the market to do that, imposed by diktat, so to speak, where the money has to flow. And that's a global phenomenon, of course. And the US under Trump is also going to move more towards industrial policy. That's the sort of environment that we have. And as we get more interventionist, that will affect the currency markets. But the malaise in Europe, I used to be quite bullish on the euro for many years. I even had a fund in that regard at some point. But it is very sad to see what's happening in Europe. And so it's I think more than the cleanest of the dirty shirts, because in Europe, when you allow businesses to invest again and allow it to have growth, and if that were inflation, or the Federal Reserve at some point would presumably have higher rates, all of that is dollar positive. And so of course the euro has been very depressed, but I would be shocked if the populists in Germany don't have much better results in the election than the polling markets suggest. And I would be shocked if the euro were to react positively to this. So in the short term, at least, I'm not giving investment advice here, but I think the somewhat weakish euro here is very well deserved.
Oh, absolutely. And apologize, I had to switch my camera. My main camera died. Apologies. So I'm going to do it like this. I'm going to turn my camera part off real quick as well. But as I mentioned earlier, like the US is way ahead of us in terms of AI and many other technologies and things. Like Europe is way behind on everything. It's really embarrassing. Energy policies we don't even need to talk about, Axel. I want to talk about the mining space with you as well. You run a mining fund. You're a gold investor as well. Maybe we'll start with gold first. I have a very specific question I want to ask you about the policies, especially if you're a northern neighbor, and what the political situation means for the mining space as well. But I want to start with gold in particular. It's holding up really well. We just talked about the DEUTSCHE performing decently, showing strength. But gold is holding up. We're at 26.2064, I believe, as we speak, Axel. What do you make of the strong gold price right now? What's that telling you? What are you taking away from that?
Well, first, for full disclosure, I'm on the record of having significant investment in gold. I've made some public filings of investing in gold miners recently, and so I might be biased. So I'll put that there with a little caveat here. Historically, the sort of gold investors you have the folks who are concerned about the purchasing power of the dollar. You have concerned about people concerned about valuations and want to diversify. You have the speculators. You have the central banks. And then, of course, if you're in an environment where the economy were to have a very negative outlook, then you'd have the anticipation of lower rates. And so if you go through these different sort of key metrics here, foreign central banks have been incentivized to buy gold because the dollar has been weaponized. That doesn't mean the foreign central banks will put all their reserves into gold, but gold is one of the beneficiaries of that trend. On the diversification side, you mentioned AI. AI is a huge trend. I said we may be in the late 90s. But there are people who are concerned about valuations. And where do you hide? Gold is one of the places. I'm not saying that is necessarily where everybody should go, but it's one of the reasons why people go there. And I think one of the bigger ones is on the fiscal side. If we have higher rates, you mentioned the kind of the interest that to finance the deficits, that's only going to get worse. I mean, we're in peacetime somewhat. And I say somewhat because I think that what's happening in the Middle East and Ukraine are just symptoms of a new era. But that doesn't bode well for the purchasing power if we can't get our fiscal house in order when times are reasonably okay. And so, yeah, investors in gold do that. Now, does that mean we can't have a correction? Of course we can have a correction, even a significant one. But it's kind of one of the reasons why investors in gold are coming to the table. And then lastly, the speculators, those folks have been mostly absent. They've gone more of the meme stocks. But if we have a significant run up or run down in gold, I wouldn't be surprised if those speculators come back to amplify volatility mostly.
Yeah, it's like I interviewed Michael Guyett the other day, and he said there's no leverage in gold, meaning there's no speculators in gold or anything really happening. We can all talk about manipulation of the gold price, of course, but there's no interest, despite gold outperforming the S&P last year.
Just a brief point on manipulation. Gold investors think they're special. And I'll get many gold bugs upset here because I don't agree with that manipulation thesis. every freaking market is quote unquote manipulated. It is not just the gold market. And with manipulated, I mean the sort of things that people allege. The moment you have derivative markets, and any mature market kind of has that, you have people that hedge, you have people that try to do arbitrage, you have people that have all kinds of motivations. That's what makes a market. And does that mean you'll have some distortions versus if you only had a spot market and no leverage? Yes, of course, that's what that means. But grow up and deal with it is my answer, right? It's just like with Fed policy, we can complain about it, but ultimately we have to deal with it. And so those quote unquote manipulations are not going to go away, and they're present in any market. I think what's relevant is that investors understand what's happening out there and take appropriate precautions. And so the kind of one of them is right, a few years ago we had negative oil prices. It's the sort of thing, if you read the small print, then you know what might be happening, and you can prepare for it.
No, absolutely. And Axel, we need to talk about what happened in Canada this week. It happened on Monday. President Trudeau is stepping down. Once a replacement has been found, that means that could be never as well. He left the door wide open. But you're a mining investor. How attractive is investing in Canada for you right now? And do you consider even allocating more or less capital in Canada now that policy might be changing?
We have a mining fund, and of course, a lot of the mining companies we invest in are incorporated in Canada, increasingly, by the way, in Australia as well. And so there are two things. One is Canada as a jurisdiction to have your base, and the other one is to invest in. And one of the things that has happened in Canada in recent years is that the First Nations, the natives in Canada, have gotten ever increasing power, and it's basically a dual layer of taxation these days. You pay taxes to the First Nations and then to the government, and the question is whether that pendulum will swing a little bit in the other direction. So these are the sort of things that don't change overnight, even with a different government. But investing in Canada have been more difficult, and so a change in government will be a positive for the mining space. Whether it's going to be a dramatic change, I don't want to jump to that. Let's see what's coming down the road. But as far as investing in mining is concerned in Canada, I think it's helpful. Just one example, right? And who knows, and the new government may not change that. There's a lot of Chinese money, for example, that wants to invest in strategic minerals in Canada, and that's been blocked. I mean, a smart government, I think, would block the export of those minerals if that's what they want to do. But why do you stop the money from building the infrastructure in Canada? So it's a change could happen one way or the other, remains to be seen. On a broader point, there is geopolitical risk in mining in every country, including the US, by the way, with permitting and whatnot. And so it's getting things done fast is often more important, and in that sense, countries that are more questionable sometimes on a geopolitical stability are sometimes easier places to get things done in. And so it's not as easy as saying, hey, I'm only going to deal in the most mature jurisdictions, because most mature means it's going to take you many years to get any permitting done.
Oh, absolutely. Given what we just discussed, Axel, should investors increase their exposure to mining stocks right now? Is that an undervalued sector?
Well, I am by regulation not allowed to give specific investment advice, and my speak is censored by the regulator, no matter what Facebook changed in its policies. I'm on the record of having recently increased. If you look at my, in the US, there's something called Form 4 for insider buying. I've been an insider buyer in the mining space. It really depends on the type of investor one is, right? Gold has a volatility about similar to that of the equities market, the S&P, but can go up. The gold mining sector has a much higher volatility. A lot of people have been burned with the major producers. They tackle these huge projects where it's difficult to be on time and on budget. We focus more on the development space, where we try to capture value as these companies go up in the value chain. Bigger investors come in, they get added to indices, and whatnot, we think that there's a lot of value there. But kid you not, it is a very, very volatile space, and it is not for everybody. Now, on the good news side is you need less of an allocation to that space to get more bang for the buck. But it is not for the faint of heart to invest in that space.
No, it's a challenging space, absolutely, and my portfolio is telling that story quite well. So it's the ups and downs are painful sometimes, I have to admit. Do you have any final advice for our audience, like for 2025? What should we be looking out for? What should we pay close attention to? Maybe something we haven't talked about yet, Axel, that might be off everybody's radar screens, but we should pay close attention to maybe.
Well, I mentioned the popcorn already. Investing is about risk management. Think about what could possibly go wrong. And then are you comfortable with that, right? You just mentioned, right, that you might not always be comfortable with the volatility, with the minus you have. Imagine volatility surging. Are you comfortable with that allocation, right? We've had an extended bull market. What people tend not to do is they tend not to take chips off the table as the bull market goes on, which means that on the way down, they lose more than they should, and they panic. The way you avoid the panic is by following the investment process, whatever that may be. A mediocre process is better than no process at all. And if you have a process. And the other thing to keep in mind, as I alluded to, is that what drives the market tends to be not what people predicted at the end of the previous year. And that's because the world is changing. There's a war somewhere. There's a scandal somewhere. There is something happening. I think it's pretty clear that you mentioned the Trudeau government resigning. The Wall Street Journal had a story the other day as well. Kind of the progressive wave is kind of ebbing out, and we continue to have the rise of populism. I alluded to the German election, so there will be disruption, and it's not going to be the end of the world. There's always going to be the next day. But you may want to think about what you do in your personal life to prepare for that, and notably also in your investments. In Europe, unfortunately, things are so rigid that people want to break things. And indeed, that may well mean breaking some of the bigger stuff, such as the euro at some point. I don't think that's going to happen this year, but that risk is obviously increasing as you have more of these populist parties going up. It's because if the governments can't have proper reform, at some point, somebody else is going to do it more forcefully. And Trump, in some ways, is going to be an anchor of stability. And if that doesn't shock you, then you haven't paid attention, right? Because we kind of know how Trump operates. We don't know what's going to happen in some of the other places in the world. And in circling back, right, in that context, I'm quite okay with the sort of gold and gold mining allocations that I have as some of these disruptions might come.
Yeah, absolutely. Big fan here of gold and silver to a degree as well. And the mining stocks, I think we're early innings still. So Axel, really appreciate your time. Like, where can we send some of our audience to follow you? You mentioned your market outlook for 2025. Where can we find it?
Well, merkinvestments.com is our website. From there, you can see the sort of products we manage. I can't mention them here. We have a newsletter you can sign up here. I'm on Twitter. I can't tweet or post about products on Twitter, but at Axel Merk is my handle. I talk about what's happening geopolitically and in the economy. And yes, I can tweet up a storm during a Fed or ECB meeting. So follow me, get engaged, and then of course on your program should you have me back.
Absolutely. Yeah. And we'll make sure it's not 11 months again, Axel. So we'll make sure that happens sooner. Thank you so much for your time. I tremendously appreciate it. And everybody else, thank you so much for tuning in. I do apologize for my camera cutting out. It's fully charged still, so I don't know what happened here. I'm just off the laptop camera, but I do appreciate your patience. Thank you so much for tuning in. I hope you enjoyed this conversation with Axel. I sure did. Always enjoy speaking with him. Bit of a different perspective on the Fed. As always, is always appreciated. So if you like this conversation, leave a like, leave a comment down below, and a free way to support us is just by hitting that subscribe button. We do appreciate it tremendously, and we will be back with lots more health and wealth in 2025 to you, and all the best. We'll be back with more. Thank you so much.